I can't believe. I'm your host, Steve Van Metre, and thanks for joining me today. Our lead story today, Charles Schwab just dropped a bombshell, and wait till you hear what they had to say, because it means the unthinkable is coming. Plus, we're seeing renewed signs that global demand is about to come crashing down. At the same time, an entire sector of a major economy is about to outright collapse. And if you're wondering what we're doing in Philadelphia today, well, all signs now are pointing to a future collapse in their manufacturing sector. Plus, we have a sponsor of today's show. You might remember Athlon Medical. Well, they're back. They're on the NASDAQ under the symbol AEMD. And stay tuned, because we're going to show you how we think we could trade their stock for a 17% return, something we'd love to do with all of our sponsors, and they've got a big update. So again, stay tuned or check out the pinned comment or description for more information. Now let's over to Bloomberg, where we're headed off to Japan to find out that exports are rising more than expected in support for recovery. And notice how this headline is written to say, hey, look, global demand is turning around because we're exporting more. Of course, what they leave out is the real story of what's going on inside Japan. The value of exports gained 4.3% from a year earlier, led by shipments of cars and medical supplies in the first overall rise in 3 months. Economists have forecast a mere 3% increase, but here's the big deal. Imports fell a staggering 16.3%, dragged down by crude oil, liquid natural gas, and coal, or what you can just summarize as saying energy. And when energy demand goes down, it tells you an economy is in contraction, it's shrinking. It's not about external demand, it's about internal demand. We want to see all countries bring up their imports. That's where you get real growth out of the global economy from. In Japan now, we're not seeing that. And wait till you pair this with what Charles Schwab said today. It's just outright staggering. Because the question is do exports lead imports, or is it the other way around? Will contracting imports send those export numbers down in Japan? Well, let's take a look at the U.S. data as a proxy. And what we have here are both imports, that's in blue, exports in red, of goods and services on a year-over-year rate of change. Again, this is for the U.S. And what do we learn? Imports, or internal demand, are telling you where exports go. Every single time, it's imports that lead the show. And so what we're seeing in Japan is just, again, a transitory bounce given the back to school, the holiday spending, and kind of this little global revival we've seen in the manufacturing sector. We told you it was unlikely to last, and based on the import data, well, we're pretty convinced that in the future, we're going to see Japanese exports turn and go the other way. The resilient external demand supports the economy, with a weak yen helping exports become more competitive, which is really all this could be. It may not be anything more than just shift of supply chain or demand, saying, hey, who's got the weakest currency? Where can we get the best deal? And maybe businesses just shifting to Japan from, say, other countries such as China. Now, that's a possible explanation as well. And at home, though, sticky inflation continues to weigh on domestic demand, with wage growth lagging behind price gains. In the second quarter, the economy expanded mainly on the back of overseas demand. Now, that's obvious, because what did you just see in the data? We saw exports rising, imports falling. But notably, what did it say here? It said sticky inflation continues to weigh on domestic demand, but here's the key part, with the wage growth lagging behind price gains. And we've noted this with the U.S. data as well, that if consumers do not keep up with inflation, they spend less. And if that happens, inflation comes down along with demand. Now you see the bigger picture of why imports lead exports. And now let's look at the import data against inflation, suggesting that Japan's sticky inflation, along with the U.S.'s sticky inflation, isn't going to be stuck much longer. Here again, you see imports of goods and services, this in blue, but now we're overlaying the consumer price index in red, both on a year-over-year rate of change. And what this means is, even though the Fed says, hey, we think inflation is going to rear its ugly head and come shooting up higher, and as well as market participants believe that, the import data says the complete opposite. Any move higher in the consumer price index will remain transitory unless proven otherwise. As exports were strong in September, though their sustainability is questionable. The U.S. economy is strong at the moment, but it's likely to slow down gradually, whereas we're making the case it's going to hit a wall at some point. You start to think about the fact that the pandemic stimulus money, based on the Fed data, was supposed to end somewhere around the end of the third quarter. So we know it's drying up or almost gone or completely gone now. We've got the student loan repayments are back. We have the higher minimum payments and credit cards due to the Fed raising the funds rate. So we're seeing all kinds of issues starting to hit the U.S. economy. It just hasn't really shown up a whole lot in the data. Of course, we know that government data is lagged to begin with. So by the time it shows it, well, it'll already be too late. And showing stress here, we see Bank of Japan steps into the debt market in an attempt to slow rising bond yields. Now, this is something I think is going to happen with all central bankers at some point around the world, because what does the Bank of Japan start to figure out is that when U.S. consumers, and you may remember we talked about this on a recent show, that dollars need to flow out of the U.S. around the world. Well, if interest rates in the U.S. are high, what does that incentivize U.S. consumers to do? Spend or save? Well, it incentivizes them to save. Bank of Japan is starting to figure this out, is, hey, maybe we need to get rates back down here. And at some point, when the global economy hits a wall, you're going to watch central bankers chase rates all the way down to zero. The problem is it won't have any effect. It's difficult for the BOJ to stop the upward trend in yields with the bond purchase operation. The U.S.-Japan yields are correlated to a certain degree, and there's no sign the U.S. yields are peaking out, which drags domestic yields higher as well. But one thing we are expecting is, of course, the Fed to pause at their end-of-month meeting that goes with a press conference on November 1st, because they just saw the backup in long-term yields that they wanted, and it takes time to see what effect that's going to have on the economy, particularly the housing market, which I imagine will also grind to a halt. And meanwhile, China's property stocks dropped to the lowest since 2009 as stress rises. And one thing, we think their stock is going to go higher. That's the sponsor for today's show, Athlon Medical, who is addressing the unmet needs in global health. You can find all their information in the description and the pinned comment below, because they just announced a big update. They received clearance from the Drug Controller General of India for a potential phase 1 trial of his hemopurifier in oncology. And if this goes well, you can see the chart set up here. They just did a reverse split, and what do we know? We show you the supply zones. The stock obviously jumped up on the split. Sellers came in and pulled down into this lower zone, and I'm going to show you on the next slide where all these buyers are at. Where does that 17% move come from? Is as the buyers accumulate shares here, and it sends it back up into that supply zone, and it could be everything to do with that trial that's beginning. And here you can see it on the 10-day chart. There's a volume profile right at $1.49. Here you can see buyers are stepping in here. That once they accumulate those shares up, that takes the next move up 17%. So you can track that again on the NASDAQ under symbol AEMD. Check out what's going on with Athlon Medical. Again, everything in the description and pin comment below. Meanwhile, property investment, a key driver of economic activity this here in China, contracted 9.1% in January through September from a year ago, a bigger drop than the 8.8% decline in the first 8 months of the year. Home sales continue to slide, falling 3.2% year to date, while construction of new homes plunged almost 24% in the period. Now remember, we said this would happen. We said that as soon as these property developers looked like they were on the brink of failure, the whole sector would start to dry up. It would put pressure on their banking system. Now, we haven't seen a bunch of articles on their banking system yet, but we can tell you the stress there is building in a huge way. Meanwhile, China's home prices are dropping faster pace and a blow to sentiment. But again, this is exactly what we said would happen when consumers see that the builder that they're going to hire to build their home, that they have to pay for up front. Now remember, this is different than the United States, where we wait until the home's built and then we buy it. In China, you buy it up front and then they build it. Well, if you don't think they have the money to finish it, which they don't, and so that makes you wonder, why would I buy something and pay for it when it will never get finished? And that is not just a little blow to sentiment, a huge one. As we see, new home prices in 70 cities, excluding state-subsidized housing, declined 0.3% last month from August, when they slipped nearly 0.3% then. And that was the steepest month-on-month decline since October of 2022. Prices slid 0.48% in the secondary market, matching the previous month decline, which is the largest recorded since 2014. The price cuts came even as major cities rolled out measures to stimulate the market, such as lowering mortgage rates and down payment requirements. And meanwhile, Chinese developers are grappling with years-long slump that starved them of cash. So now we come back to this whole thing about not having enough cash. And you start to look at what happens when central bankers invert yield curves and invert money curves. The system starts to get starved of cash. And this is why everyone thinks that rates can't go back down. No, rates are going to go back down, because when demand in the global economy eventually hits a wall, the only solution will be to lower rates. And even at zero, you're going to watch, it won't work. And so what's the problem with China right now is the same problem we're seeing in Japan, is there isn't enough dollars. They're not moving out of America. They're not getting overseas. And all of a sudden you're seeing these property developers just can't get cash. And that means they're on the brink of failure. And meanwhile, what we see is home sales and property investment remained a drag on economic output last quarter, underscoring why policymakers have taken steps recently to rekindle demand, which we said would not come back until the global economy returned. And further evidence of that dollar shortage, well, this headline from Zero Hedge sums it up perfectly, as China. Foreign central banks dumped their U.S. treasuries as yields blew out. And it wasn't that they were selling them because interest rates went up. They were selling them because they needed dollars. And you start to see this recurring theme all around the world. Dollars are getting trapped in the U.S. commercial banking system because the Fed raised rates. U.S. consumers are rather save now than spend. That's keeping dollars from flowing overseas. And all of a sudden, it's choking out the global economy. We haven't seen it happen yet in the U.S. Now, we are going to see it hit a wall here at some point. Then what we're likely to see is something collapse overseas, whether it's China, maybe it's a German economy, something else is going to break first, but we won't be that far behind. Meanwhile, let's head over to Philadelphia. What do we find here? The Manufacturing Business Outlook Survey. Well, survey says the future is not so bright, as manufacturing activity in the region was mixed this month, according to firms responding to the survey. The indicator for general activity remained negative, while the indicators for new orders and shipments were positive but low. The employment index turned positive, and both price indexes indicate overall increases in prices. Firms continue to expect growth overall, but over the next 6 months, most declined. If you can imagine that, that is a big deal. Now let's take a closer look at the report, and what do we find? New orders. They did pick up a little bit. Remember, we said we needed to see that, but really, that could be the holiday effect here. How about unfilled orders contracting at a faster rate, minus 16.8 versus minus 13.6 the month before? How about this? Prices paid are up, but what matters, prices received are not as up as much, meaning a lot of these firms are being squeezed at the margin, suggesting they're not making the profit they need. And while the number of employees went up, the average work week, which is more important, went down. So it goes to show that these manufacturers are adding employees, but they just don't have the work. They're burning through those backlogs in hopes, like everyone tells them, we're going to see a turnaround in the global economy. We never see a turnaround when money conditions are tight, because there's not enough money to create growth. And that's what a lot of these experts just don't understand. But we've seen from these manufacturing surveys a lot of optimism about the future. And I had questions about this, thinking it had more to do with the fact that they were just being optimistic instead of actually having potential orders on the books. And here we can see future indicators decline as the diffusion index for future general activity edged down from 11.1 to 9.2. The shares of firms expecting increases in activity over the next 36 months, which is 36% of them, exceeded the share of expecting decreases, or 27%. More than 31% expected no change. But here you go. The future new orders index decreased 7 points, while future shipments dropped 25 points, the lowest reading since May. And firms continue to expect overall increases in employment over the next 6 months. And meanwhile, the future capital expenditure index fell from 7.5 to minus 4.8. And that's a big decline. So what we're seeing here is still mixed opinions about where the future is. But if we look at what Schwab had to say now, what you can understand is the unthinkable is coming. As America is in a cardboard box recession, it says demand for services is cooling and inflation could surge again. Well, we know the last one's not likely to happen. And through recessions, typically we see all sectors of the economy shrink. A contraction is currently only apparent in the manufacturing and trade industry. This from Kleintop. According to the Fiber Box Association, that's led to a drop in cardboard box demand, an overlooked recession indicator that has preceded previous downturns. for the U.S. economy. So you think about this, if people are buying less stuff and having less stuff shipped, well, you need less boxes, making it a really good indicator. And while recessions are officially declared by the National Bureau of Economic Research, Kleintop said the economy was currently in a cardboard box recession, which could bring on weaker job market, which we made the case is coming, and more earnings pressure for corporations, something we've also suggested. Investors could also see muted stock returns. Well, that's an understatement, especially if weakness spreads to other sectors like services. So here's what we know is internally demand in the U.S. is indeed starting to cool off. It's not just China. It's not just Japan. It's not just Germany. It's not just the rest of the world. It's the entire world, because when you start to understand central bankers have curtailed the growth of money in the global economy, it's slowly drying up because we prioritize debt. In a debt-based economy, the payment of debt is foremost over everything else. And when debt is paid that's been borrowed from a commercial bank, it is destroyed from the economy. And when you have a lot of zero interest debt or low interest debt, you see these payments are going back to principal. Money is being removed from the system. And it's not a good thing. At some point, it accelerates to the downside. But one thing we see is going to turn up, and that's going to be initial claims. As U.S. jobless claims fall to 198,000, the lowest since January, but that's not the issue here. Continuing claims, a proxy for the number of people receiving unemployment benefits, rose a whopping 1.73 million for the week ending October 7th. That marked the highest level since July, indicating that those losing their jobs may be having more trouble finding new ones. This leaves a question that you might have is who leads what? Does initial claims lead continuing claims, or do continuing claims lead initial claims? Well, the answer to your question is continuing claims lead initial claims. Here you can see on this chart here, what do we see in blue? We have initial claims and continued claims in red. And when continued claims do not continue to fall along with initial claims, what you notably see is initial claims start to tick higher, suggesting that in the months to come, or perhaps even less, maybe even weeks, we should start to see a renewed increase in initial claims, despite what we just saw out of the Philly Fed report saying they're looking to hire. The question only becomes is somebody's going to be looking to lay people off. What sector and how many we don't know, but the fact is people on unemployment aren't able to get jobs, and that means other people are running out of work. We see the backlogs declining. We're seeing the new order growth not being big enough to sustain the existing workforce, and it all eventually leads to a further decline in cardboard box demand, and that means, of course, as Schwab pointed out, an increase in unemployment and an overall broad move to recession before we hit an all-out financial crisis. And with that, I'm Steve Van Meter. Thanks for watching. Thanks for being fans. And as always, with any sponsor we have on our show, you're under no obligation to purchase their stock. Be sure to do your research before placing any trades. All right, bye now.